Hello, it's Miles Pitcher, Superior Lending, coming to you today with a mortgage tip. Um, I am going to, we have a mortgage tip that is really, I'm going to kind of nerd out today on you because there's a lot of stuff going on. Look at this rate chart, and you can see that uh, we've had rates improving, and then coming up here, these little yellow arrows are lock alerts when we lock in our clients because we knew some things were coming this week that were going to make rates worse. This is an inverse chart, so as this chart's moving down, rates are going up. So it's been a rough couple of days here on our rates. They're still fabulous, still 2.75 for a purchase with excellent credit, but you can see what's going on here. And today I wanted to cover a little bit about what's going on and why and what's happening with rates so you understand. Yeah, what's affecting mortgage rates? I'll get to the chart in a minute here, but click to where I am. All right, so a few points. Number one, I still get questions all the time or comments about the Federal Reserve and Fed funds rates. Federal fund rates do not directly tie to mortgage rates. The, for example, I'll just keep moving along here. One of the things, though, that we do watch closely is we watch the comments from the Federal Reserve Chairman and their forecast that they have. Our mortgage rates price in those comments and where they expect things to move. Fed fund rates right now are at zero. No, mortgage rates are not at zero. Yeah. Now, the big move today, and the big thing is inflation. Inflation very much just reflects on, hey, how much did a gallon of milk cost you a year ago? How much does it cost today? How much did the home cost you, the same home cost a year ago that it would cost today? So that's the idea of inflation. Numbers came out today that the consumer price index, which is how they measure inflation, increased from 2.6% to 4.2% year over year. That is the biggest increase we've had in the last 13 years. And I threw a chart over here for you to look at. What's interesting is seeing this spike. I mean, it's massive in there, and you can see that we are coming from a really low inflation point down here. But no surprise, inflation is happening, and the mortgages react to inflation by raising. While the Federal Reserve has said that, hey, we're not going to raise the Fed funds rates, we're going to let inflation run a little bit, the mortgage rates have raised to help cool that off. This chart is really interesting. Jumping back to the Federal Reserve, they are purchasing mortgage-backed securities right now. So let me restate that. That means the Federal Reserve is taking money and going into the bond market and buying mortgage-backed securities. What is this doing? It is creating an artificially low rate. It's not a real rate. Rates are low and they're great, and it's partly because the Fed is buying. We don't know how long they're going to continue doing that. When they stop doing that, rates are going to move up. So if you see these orange columns in the chart, you see it says QE1, QE2, QE3, and then now we're over in COVID QE4. That's quantitative easing. What that means is the Fed is buying rates to make them artificially low. Okay, so when that stops, rates are going to move up. So we have a lot of things happening right now affecting rates. Number one, inflation has made rates worse today, the inflation numbers. And we don't think inflation is going to stop. It's going to keep going. Okay. We also have that counterbalanced by the Fed buying bonds, buying mortgage-backed securities. And at some point, we don't know when they're going to stop doing that and rates will move up. They will taper it off. It won't be a cold turkey kind of a thing, but rates will move up because of it. The other factor into the mortgage rates is the economic growth. As the economy, housing, everything does better, or the gross domestic product, rates will move up as that happens. So I hope that gives you an idea of what's going on with rates. How does this apply to us? Okay. So I want to show you kind of what the cost of waiting is. Number one, we've talked about interest rates and how they're moving up. Number two, we've also talked about inflation or the price increases in homes. So I've thrown a scenario together for you here that shows, hey, what if we have a client buying a $500,000 home, they have 20% down, they have great credit. I've taken the average of a bunch of different agencies, and they are projecting 6.8% appreciation in home values into 2021. They also project, these same groups, by the end of 2021, rates will be up around 3.4. That's the average of all the groups. Some are higher, some are lower. So if we took that $500,000 home, the loan amount with that would be $400,000 with 20% down. Today's rate 2.7, principal and interest 16.22. Let's look at the end of the year. That home now has moved up 6.8%. I think the number, it was like 529,000 or 527,000. You put 20% down, that means your mortgage now is 427,000. So higher loan amount. Rate is also higher. That means the monthly payment is going to be $1,911. Can you believe this? A difference in monthly payment of $288. Okay. Over the life of the loan, $76,000 worth of interest that you'll be paying. Difference in the higher rate and higher loan amount. Pretty crazy. So for your clients who are like, oh, I'm not sure if I'm going to, buy right now, I'm going to wait down the road. Well, if they can agree that home prices are going to continue moving up, you can also tell them, or I'm happy to tell them, that rates are going to move up. Why? Because inflation is moving up, and the rates will move up to counterbalance that. And at some point, the Federal Reserve is going to taper off dumping money into mortgage-backed securities. So yes, rates will go up at some point. Yeah, the affordability right now is awesome. It will gradually get worse, in my opinion. But I just wanted to show you this and the cost of waiting. As I mention every week, hey, we believe every client needs to be able to understand every fee that's on their loan estimate, closing disclosure. And I also believe that every client should have options shown to them when they're looking to buy a home or refinance. There are plenty of options in this industry for them. So let me know if you have any questions. Sorry for nerding out today, but there's big things happening with inflation coming into rates and how that's all going to affect us and the buying power of our clients. I hope you have a great week. Miles Pitcher from Superior Lending.